Welcome. The presidential election, the fiscal cliff, and even the federal budget sequester could not hold the markets back in the first quarter. It's amazing that the current level of political dysfunction has almost become the norm. The domestic markets posted strong gains for the first quarter and set new all-time highs. For the quarter, the S&P 500 leaped by 10.6% after posting a 16% return last year. The stock market rally has expanded and contracted 3 major times since March of 2009. We should expect another pullback, most likely this summer, before establishing a foundation and climbing higher. The overall growth of the S&P since March of 2009 is up 153% and is 13.2% above the peak reached in October of 2007. Another very positive indicator is that the Barron's big money ratio has reached a new all-time high. This should bode well for the markets moving forward. According to the International Monetary Fund, IMF, the global economy is expected to continue mending gradually. The latest forecast for global economic growth is projected at 3.3% for 2013 and 4% next year. For the quarter, the EFA index rose 5% and emerging market dropped 1.7%. Keep in mind that with the old dangers remaining and new risks emerging, policymakers cannot afford to relax their efforts. The CEO Economic Outlook Survey Index, a composite index of CEOs' expectations for the next 6 months of sales, capital spending, and employment, jumped in the first quarter to 81, up from 65.6. The current situation has made equity valuations seem reasonable, with the forward PE ratio of the S&P index at 13.8 times compared to the 20-year average of 16.2 times. Corporations still maintain the highest cash reserves, borrowing costs are at an all-time low, the S&P earnings per share is higher than pre-recession levels, and financial leveraging has dropped to the lowest level in 3 decades. The current PE ratios are below their averages. For example, large cap lens stocks are 14.8% cheaper than their historical averages. This leaves some more room for growth. Domestic growth has been subpar and will continue for some time, but the economy has enough underlying durability to keep growing modestly. The real gross domestic product, GDP, for the fourth quarter was barely positive, but we expect it to rebound in the first quarter. With the slowdown in government spending, GDP for the year could be below 2%, but we anticipate it'll be higher. We expect GDP to build through 2013 and into next year. On a positive note, we've exceeded the lost output during the recession by $339 billion. The Conference Board Leading Economic Index, LEI, an indicator of economic activity over the next 6 months, increased for the first 2 months but dropped slightly in March. The Coincident Economic Index, CEI, a measure of current economic conditions, posted similar results. These indicators still point to a continuing but slow growth environment. According to Ken Goldstein, economist at the Conference Board, and I quote, "The data for March reflect an economy that has lost some steam. In addition to the headwinds from government spending cuts, the private sector economy may struggle to maintain its momentum. The biggest challenge remains the weak demand due to nervous consumer sentiment and slow income growth." End of quote. Governmental shortcomings. We cleared the hurdle of the fiscal cliff only to find the U.S. policymakers unable to reach a deal to avoid the $85 billion in automatic spending cuts. Everything just keeps moving along despite the lack of leadership in Washington. We need to stop moving from crisis to crisis, solve our budget problems, and adopt a long-term plan to promote the economy. There needs to be an end to quantitative easing 3, QE3. This is when the Federal Reserve prints money to buy back our long-term debt. Some of the members of the Fed actually agree with me, but Wall Street loves the program. The problem is this causes a devaluation of our dollar, making the U.S. less competitive internationally. just at the time that we need it for growth. Eurozone. Europe looks to spread out the pain of fiscal tightening by focusing on cyclical adjusted deficits as opposed to calendar-based targets. The actions of the European Commission, ECB, and IMF are a positive development and amount to short-term fiscal easing. Aided by the tax cuts in Germany, these actions may halt the downward economic spiral and help beat the growth expectations for the year. Housing. The recovery in housing continues to provide a significant positive catalyst for economic growth and helps offset some of the softness in the manufacturing sector and international trade. Sales of new and existing homes continue to increase throughout the first quarter. The inventories of homes for sales are at levels not seen since the early 90s, which has helped push home prices higher. Housing permits rose in February to an annualized pace of 946,000, which is higher than sales. This is an indicator that home sales will pick up in the next few months. This is one of the brightest spots in our economic growth picture. Employment. The unemployment rate remains high at 7.7%, and the dismal job growth of March shows that across-the-board automatic spending cuts are starting to affect the economy. Businesses seem willing to hire, but Washington presents an ongoing hurdle for them. Hopefully sometime soon, the administration and Congress will settle the battle over raising the debt limit and negotiate a long-term deficit reduction program. Only then will corporations be willing to commit to long-term expansions, which will create jobs. At some point, businesses will take a leap of faith, which will offer a tremendous opportunity and a big boost to the markets. Closing thoughts. As we indicated in our prior commentary, we believe this could be another great year for the equity markets, despite all the continued issues in Washington. The markets have to contract to continue to move forward, so we should expect some volatility as the markets move higher. We expect the consumer, housing, export gains, and pro-cyclical sectors to continue to drive the economy in 2013, while the manufacturing sector could regain its strength in the second half of the year. There's plenty to worry about with Iran, North Korea, our stalled government, the recession in the Eurozone, geopolitical risks, and slower growth in China. To top it off, we have the concern over increasing interest rates and the effect on bond valuations. The problem with the bond market today is coupons are so low, there is little, if any, protection from rising rates. This creates a changing paradigm of moving out of the safety of low-yielding bonds into the stock market at these current levels. We don't expect interest rates to rise anytime soon, but we definitely need to keep our eye on them. We have talked to many of you about the silo investment concept that I have developed, and the feedback has been very positive. It is a new way to look at your investments, and it should better align them to meet your goals. Please contact us if you have any questions or concerns about your financial future. We are here to serve you and your needs. Thank you for listening and your continued support.